to Trendlines, a podcast on global affairs brought to you by World Politics Review. I'm Elliot Waldman. Before we get started, a quick note to our listeners that if you like what you hear on Trendlines, I hope you'll consider subscribing to the show or even leaving a positive review. It really does help sustain our work. And if you'd like to explore all the other topics we've covered in the past, you can find a full archive of the show at worldpoliticsreview.com/podcast. In 2015, a report from the McKinsey Global Institute found that up to $28 trillion could be added to global GDP by 2025 if women achieved parity with men in labor markets. Put another way, the world economy could expand by a projected 26% if only women were allowed to achieve their full economic potential. Yet, according to the World Economic Forum, there are more than 70 countries where women are not allowed to open bank accounts or obtain credit. The gender gap in financial account penetration tends to be widest in certain emerging markets like South Asia, sub-Saharan Africa, and parts of the Middle East. Even when financial services are available to them, women often face bias and discrimination at various stages of the lending process. But the emergence of new financial technology companies and mobile credit platforms, accessible with just a few taps of a mobile phone, could change that, offering loans even to women with little or no credit history. The nonprofit Women's World Banking recently released a report finding that, for women who have historically been the victims of unconscious bias in lending decisions, algorithm-enabled credit decisions could create a level playing field. But tapping into that potential will require addressing the myriad other forms of bias that can creep into artificial intelligence algorithms. Joining me now to discuss the report and the importance of gender equality in finance more broadly is the president and CEO of Women's World Banking, Mary Ellen Iskandarian. Welcome to Trendlines.
Thank you so much, Elliot. It's great to be here with you.
Let's start with the question of why your organization has been focusing attention on new mobile technologies and credit platforms to expand access to credit for women. I know you've mentioned that this is a new area of focus for your group. And I think, first of all, it's important to understand the role that women's financial inclusion plays, not just for households, but for macro-level economies as well. So what do we know about the benefits of making sure women have equitable access to credit, especially in emerging markets?
Well, first of all, Elliot, thank you so much for phrasing the question the way you did, because there's actually some really powerful data that's emerging and research that the IMF in particular have done that shows very strong linkage between financial inclusion and economic growth. And probably most importantly, in the times we're living in, a very inclusive growth, so growth with equality. But what is really fascinating, and it's interesting that some of the people I've talked to at the IMF, we're absolutely not looking for gender effects, if you will, but they found that sort of nothing drove inclusion and equality as powerfully as the financial inclusion of women. So it's really quite a driver of so many other macro changes. And we're only just beginning to see that it's not just the financial inclusion of those who've not been in the formal financial sector in the past, but specifically by women. And some of that is, as you were alluding to, household-related reasons. Women tend to be the risk managers in the household. They tend to be the savers against a rainy day or for health emergencies or the children's education. But they also, when they have it available, they are much more likely to buy insurance. Again, health, very strong driver, and they're very motivated to buy those products if the entire family can be protected. So, selling a woman health insurance for herself may not be as motivating. We know women, at least in the women that we're working with, who might be in lower income strata in emerging economies, tend to deprioritize their own health, except when they're pregnant. That's when we see them taking good care of their own health. But their interest in protecting against health emergencies really is heightened if the entire family can be protected. But Then, as you also said, for women-owned businesses, women in SMEs are depending on the country anywhere from 50 to 90% of private sector employment, and women are making a larger percentage of newly created small and medium-sized businesses every year, both in developed and in developing economies. Women-owned businesses tend to hire more women, so not only are so-called SMEs great job creators, but women-owned SMEs are great job creators for other women.
And just to define our terms for listeners who might not be familiar, SMEs is small and medium enterprise. Is that right?
Correct, as distinct from, I guess, from a micro, which would be even smaller, either an informal business, which isn't going to be registered, the classic, fruit seller on the side of the road kind of thing, or can be a registered business, but it's often defined by, the number of employees being roughly 10 and above, kind of puts you into that small category, and then medium is significantly larger than that. Percentage of number of assets also defines where your business is categorized.
And now, are the insights that you're talking about consistent across cultures and societies?
Yes, that's what's, I think, so robust and exciting about the IMF data, that we're not only showing that the growth holds, across cultures, across economies, but in some places, McKinsey did some interesting research looking where financial inclusion could be perhaps an even greater driver of growth, of economic growth, if women had equal access. And we saw that in both South Asia and sub-Saharan Africa. So two of the areas where the gender gap and the overall lack of inclusion in the formal economy is very, very great. Financial inclusion for those regions, in particular, are really driven by financial inclusion.
And what are some of the factors that have traditionally held women back from equitable access to finance in these contexts?
Oh, it's a long list, but if we're talking, things as basic as identification, women typically may not have the vast array of documentation. Very often women's births or girls' births are less likely to be documented. The other kinds of documents that banks often ask for in order to open an account, let alone to get a loan, are just so much less likely to be held by women. But we're seeing increasingly, and as you mentioned at the top of the show, our greater focus on digital in recent years, is we see the advent of mobile technology as just being a huge game changer to bring many more people into the formal financial system. But we have to make sure that women have access to that mobile technology. There is still, unfortunately, a real gender ownership gap with cell phones, less so the sort of old-fashioned flip phone or feature phone. But if you're really going to be doing financial transactions on the phone, increasingly that requires an internet-enabled, or what we think of as the smartphone. And there you see quite significant ownership gap between men and women of smartphones that allow them to enter that digital financial system.
Okay, well, let's dig into that a little bit. There was this fascinating report that you and your colleagues released a few months ago, and you talked about how it's become very easy in the past 5 or 10 years to request a loan through the proliferation of these financial technology companies, or fintech companies as they're known, and mobile credit platforms. So if someone wants a loan, all they need to do in many cases is download the app and fill out an online form, which seems really revolutionary in countries, especially where you have limited telecommunications infrastructure, where the way most people access the internet might be through their mobile devices. So talk a little bit about how this differs from the way people in these contexts went about trying to access credit in the past, and how it expands access to credit for people who might have been left out.
As you say, it's really been quite a game changer to literally have, effectively have your bank in your pocket on the phone. Just the number one reason that most low income people who remain unbanked or not included in the financial the financial sector in the developing world still give it's too far. The bank is just too far for me to travel, or I don't have enough money. So the idea that, a very small loan or a small deposit wouldn't be worth the time and effort to take to go to a bank branch that may be several miles. I mean, for years, I've had women tell me that the bus fare to the town where the bank branch was located was more than she intended to deposit in the first place. So the ability to do small, frequent transactions, which for women in particular is really the way they like, certainly the way they like to save, and often the way they like to borrow. So being able to do those small, frequent transactions is a real plus. The other piece of that equation, though, and why these fintechs have really taken off with the credit model is the availability of data, the availability of information around which these lenders can create credit scores using, data that you wouldn't ordinarily either have access to or think of as related to, financial services. The traditional credit bureaus, there are still a majority of the developing countries in the world do not even have credit bureaus. Where they have them, they tend to reflect, less than 5% of transactions completed by less than 5% of the population. So certainly not the low income population that we're targeting. And they're often not collecting data about, how well you pay your bills. Do you, how do you either when you shop, how are you paying off any purchase that you might have made, your utility bills? Many countries do not look at how well a woman performed in a microfinance loan. So maybe she has a terrific track record in repaying microloans to a microfinance institution. She wants to graduate to a loan from a mainstream bank, and that history is just doesn't exist. She's got to create a credit score from scratch. So the ability to use data like how well she's topped up her, she's paid for her cell phone. They often look at, do you wait until you're very, right at the last minute, or are you paying and planning your purchases over time? There's just a whole myriad of behavioral data that can be put to work to form a credit score that really can benefit women. Now, it gets into data privacy issues, and we've seen some really interesting recent research from the BIS, the Bank for International Settlements, that's indicating that women are more suspicious and more nervous about data privacy issues than men, and are maybe even willing to give up financing, even maybe on better terms, if they are not certain that their data will be protected.
Is that a sign of perhaps just a general aversion to risk, do you think?
That's a great question, because there's a huge debate. You can find reams of academic research on both sides of the question. Are women more risk averse than men? So I can't really put my finger on either side. What I can say, though, is we see sort of across the board that women do take longer to form trust relationships with financial institutions. They often will first think, this bank really isn't for me, or they don't really want my business. And frankly, in many cases, particularly in the low income segment, they're not wrong. They haven't been treated with particular dignity or found products that are resonant with them. But I think it speaks more to that trust building that we see women with all sorts of financial transactions taking longer, but the real payoff, and this is why I always think that financial service providers should look at the longer term. There is, again, significant data showing that once that trust has been built, women are much more loyal clients. They will stay with a financial service provider. On average, they are much more likely to be a client after 5 years than a man, and they are much more amenable and open to the cross-selling of products than men are. So you'll often see over a lifetime the customer lifetime value of a woman client actually being higher than for a man.
This strikes me as fascinating because we've been talking mostly about emerging market economies, the developing world, but there's also, in many developed countries, a large portion of the population who's unbanked and could probably benefit from these types of technologies. But is that, are we seeing this kinds of phenomenon in all sorts of countries around the world, not just emerging markets?
Very much so. I do think that the emerging markets have sort of done a bit of a leapfrog in the sense that it seems to me the vast majority, and I can stand corrected on this with other data, but it seems that the vast majority of fintechs that are popping up here in the U.S. tend to be more payments focused. There is some peer-to-peer lending, or actually quite a bit of peer-to-peer lending that's taking place. But I think what we're seeing in the emerging markets is a much broader product base that's being offered. You're seeing more savings tools, although some of the most popular financial technology in the U.S., for example, has been the Roundup, that you kind of force yourself to save by rounding up a purchase and putting that additional money into a savings account. You're also seeing a growing interest in digitally delivered insurance products. Some really interesting models that kind of mimic the success of say a mobile phone subscription. So insurance that's done on a monthly or quarterly subscription basis. So you're not, because that's always a huge issue. I think it really everywhere in the world, they always say that insurance is never bought, it's only sold. And so I think if people can get their minds around, insuring themselves for shorter periods of time, and the data that's generated through the mobile phone allows that insurer to properly assess and underwrite that risk.
So talk a little bit more specifically about the kinds of benefits that these credit platforms and fintech companies offer. For example, are they cutting out the human interaction where there was a lot of bias taking place previously?
The bias issues are sort of legendary. There are a lot of stories about credit profiles or credit applications in banks that, when submitted with a man's name or a quote unquote man's occupation, the loan gets approved. Exact same business application, all the same details, but sort of gender markers of a female get turned down. So there's definitely, bias in the more sort of analog system. What we're quite concerned about in the report that you referred to, that Women's World Banking had published a couple of months ago, was just kind of almost a cautionary tale about making sure that we're not building that same kind of bias into these alternative credit scores, into the algorithms that are being generated. But I think when you speak specifically about the benefits, there is certainly an opportunity. We're still young in this industry to solve for those bias issues, but you're seeing tremendous convenience issues that you don't have that visit to the branch that I was talking about earlier. You see some very clever models. You're starting to see more and more of these fintechs, in essence, embedding themselves into the payments systems of the company. So a loan doesn't have, a 1-year loan doesn't have an equal 12 monthly payment, but sort of tracks the business's own cash flow and knows when the business has certain amounts of money coming in, and is adjusts the payment accordingly. You're seeing some models where the entrepreneur doesn't actually receive the money at all. That there'll be an arrangement with someone in the entrepreneur's supply chain. We're seeing in Latin America, there's some really clever models that are helping shopkeepers who say, buy a lot of products from Coca-Cola or Pepsi or fast-moving consumer goods companies. They'll take the merchandise that's been ordered, and then the payment goes directly from the fintech to the fast-moving consumer goods company. So some really clever models, I think, that allow an entrepreneur to borrow without having to, sort of run the gauntlet of a credit history or having lots of collateral. There are countries still where the only acceptable collateral against which to write a loan is property. And in some places, it can't even be, built property. It has to be actual land. In those same countries, women may not be allowed to inherit land or own land in their own name. So the issues around collateral that can be worked around with the fintech are just enormous, and an enormous benefit for women in particular.
And what is the range of data that's being collected here? I thought that was one of the most startling aspects of the report, all the different types of data that is being collected in order to form this lending profile based on that digital footprint.
I agree with you. That was a real shocker when my colleagues first presented the report to those of us inside. There's, I think, the piece of data that I always find so amazing is apparently there is some credit algorithm or some element that looks at the amount and the number of times you use the flashlight feature on your phone. So there's a whole range of both behavioral things that one does on the phone, the number of keystrokes, the number of swipes, the amount of time you spend on the phone, all of those things are assigned a weight or an input into that algorithm. So there's just a vast amount of data that's being collected, even if it's not immediately intuitive that it would have some implication for your credit quality.
I think by now a lot of our listeners are pretty familiar with the ways in which AI algorithms have been discriminatory in the past, like facial recognition systems not recognizing brown and black faces as well as white faces, for instance. How do these types of biases show up in these kinds of credit apps with regard to women trying to access loans?
Well, any kind of gender marker. So the type, names and names are very frequently used, and it's as with so many of these things, there's sort of they're a bit of a two-edged sword. Women's World Banking is probably one of the loudest and most frequent promoters of the need for both regulators and financial service providers to collect gender disaggregated data. So a financial service provider actually can understand who their clients are and how their clients are using their products. And have been technologies that have been built that work off of the name and how, whether the name is likely to be a woman's name or likely to be a man's name. So any gender marker, the idea that it might be a hair salon versus a construction business gives an indicator of gender. The irony is the microfinance industry has proven for decades now that there's probably no set of businesses that can improve your portfolio quality better than hair salons. They are very, very profitable and very good loan repayers. But that aside, they are also, unfortunately, that provide that sort of gender marker. Not necessarily a credit question, but I don't think we can ever underestimate sort of the human drive to make these distinctions. I'm sure you've heard the very famous study of the Boston Symphony Orchestra trying to increase the number of women in the orchestra, particularly in the violin section. And so they started doing blind competitions. The women would sit behind a curtain and the judges would not be able to see if they were men or women. But even after a few years, they just were not seeing the results that they had hoped, and learned that women would, it was an important day, a woman violinist would show up with her high heels on. And so the judges could hear the clicking of the high heel and immediately know that they were listening to a woman. So now all violinists perform in their stocking feet for the orchestra transaction. So tryouts. So it's this. There's something in our human nature that just sort of tries to create these categories.
It's fascinating. I mean, it's the judges might not even have been aware of the fact that their mind was operating that way, and hearing the clacking of the high heels and implicitly assuming that was a woman. So what kinds of recommendations does your report arrive at in terms of how to address these biases and harness the potential of what these fintech companies are offering without the negative side effects?
So as with so much of our work, we're really just advocating strongly to just be conscious, to be aware that there is going to be this tendency to bias, to look with that gender lens whenever an algorithm is being derived. So I think it's right now it's about awareness. It's about not making assumptions. That even with the best of intentions, there can be a bias that not only, is harmful to, the woman-owned business who's denied a loan or gets a loan on worse terms, but there are really business reasons that the banks are losing out on business or these fintechs are losing out on business if they're not, writing the loan that is best suited to that business.
And we were talking a little bit before we started recording about how these old school brick and mortar or established credit mechanisms are actually, in a lot of cases, doing pretty good work that we can harness and establish sort of better safeguards to try to utilize those.
Well, it really gets back to something we've talked about a couple of times in this conversation, and that's really collateral. The vast majority of loans around the world, even where you have regulatory environments that are a little bit more lenient about the definitions of collateral, still require very significant collateral against a small and medium-sized enterprise loan. We're talking of 130 to 150% of the value of the loan very often being required as collateral. And the number one reason that a woman entrepreneur will choose not to apply for a loan is the assumption that she will not have adequate collateral. So there are a couple of things going on here. One is you were referring earlier to the tried and true methods, is just going back to good old fashioned cash flow based lending, looking at the business, seeing if that the revenue generated from that business can repay your loan, and not relying on the recovery value from the collateral that you might be taking. Women's World Banking did an extensive piece of work with the largest bank in Kenya Commercial Bank, to build in, and who wanted to increase their lending to women-owned businesses. And we helped them build out a cash flow-based lending platform that was really beyond our wildest dreams in terms of the results. We saw loans to women increasing, more than doubling. And the credit department was very skeptical about going to this no collateral against the loan, and you saw no change in credit quality whatsoever by adopting this cash flow method. But then the other thing that I might just add in terms of on the regulatory side and is to think more about things like movable collateral registries. The vast majority, 86%, I believe it is, of U.S. Small business loans are where they do have collateral taken. It is movable collateral, so equipment or a car, rather than a immovable collateral like land or property. And where countries have introduced them, you've seen, again, outperformance by women-owned businesses and taking advantage of the ability to receive a loan that's collateralized by a piece of equipment that she actually might own, as opposed to one that she's prohibited by law to have in her name.
Are there any final thoughts or insights that we haven't covered that you'd like to leave us with?
Well, I think that certainly the pandemic has shown us that technology can be our friend. Technology can help us, leapfrog things that we never dreamed we could overcome. And certainly, I think that's been the case for financial services. I just hope that women are given a shot at having the technology at hand, as that's really the gating issue that we need to solve. But to the extent that this pandemic has hurt women economically, they've lost jobs at a greater rate, they're being slower to return to their businesses. I think we all want to support women-owned businesses and women-owned businesses that hire other women. And if digital credit is a tool for that, then it can be a really exciting response to the current situation.
Fantastic. All right. Well, thank you, Mary Ellen. It was great to have you on the show.
Thanks so much, Elliot. I had fun.
Mary Ellen Iskandarian is the president and CEO of Women's World Banking. If you'd like to comment on the discussion, ask a question, or even suggest a topic for a future episode, drop us a line at podcast@worldpoliticsreview.com. This episode of Trendlines was produced by me, Elliot Waldman, and edited by Peter Dury. You can follow the team on Twitter if you'd like. WPR's handle is @WPReview. I'm at Elliot Waldman with 2 L's and 1 T, and Peter is at PeterDoerrie. Thanks for listening, and tune in again next week.